In 1942, 80 years ago, I took $114.75, every penny I'd saved, and I bought 3 shares of City Service Preferred. And City Service was a pretty well-known name now and then. You don't need to be a genius in what I do. That's the good thing about it.
Imagine being 11 years old and already trying to crack the code of the stock market. As a child, Warren demonstrated a passion and flair for numbers that was way beyond his tender age. He was not simply daydreaming or playing with toys like most 11-year-olds. He was already trying to decipher the complex world of finance and investments. His mind was constantly buzzing with questions. How did stocks work? What made them rise and fall? What strategies could be used to predict their movement? This led him to dive into the world of technical analysis, a method used by traders to predict future price movements based on past market data, primarily price and volume. He was like a sponge, quickly absorbing all the information he could get his hands on. Books, magazines, newspapers, no source of information was too trivial for him as he sought to quench his thirst for knowledge. Yet, despite all his efforts and dedication, Warren was still missing the bigger picture.
When I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. I mean, hundreds and hundreds of pages. And I read that whole thing over and over again. And I read Garfield, Drew, I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market.
Fast forward to his late teens. This was the period in his life when Warren Buffett stumbled upon a significant book that essentially altered the trajectory of his life and career. The book was none other than Benjamin Graham's renowned publication, The Intelligent Investor. This book was not just a collection of pages bound together, it was a door to a new world, a game changer.
And then I read Ben Graham, when I was 19 or 20, and I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. And I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded. But I became an owner of a business. And I did not care whether a stock went up or down the next day or the next week or the next month or the next year. And I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses.
The concepts and principles it presented challenged and reshaped young Warren's perspective towards investing. Warren, who was previously focused on predicting stock movements, soon realized that strategy was not adequate. This revelation was not just a slight shift, it was a paradigm transformation. The book pushed Warren to reassess his investing strategies. He decided to stop being a spectator on the sidelines of the stock market. He decided to become an active player. He understood that to think like a business owner rather than a mere stock picker. He that a business's value is not solely determined by its stock price. From that point on, his investing strategy took a 180-degree turn. Every investment he made was not just a purchase of stocks. It was an acquisition of a business. These businesses weren't just any businesses, they were publicly traded corporations. What Warren cared about was not the short-term fluctuations in the stock prices. He was interested in the long-term prospects of the companies he invested in. He wasn't just an investor, he was a long-term business owner. He didn't care about short-term fluctuations, he became a long-term business owner. Now, let's delve into the heart of Warren's investment philosophy. It's not about boasting an extraordinary IQ or possessing the Midas touch. It's about adopting the right perspective, a perspective that from the standard.
I'm a bright guy who's terribly interested in what he does. I am in a game. You probably need 120 points of IQ, but 170 doesn't do any better than 120. It may do worse, probably do worse, but you don't really need brains. You need right orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
Pardon me?
And what do you think about?
I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it, because I'll buy more.
Warren, with his profound wisdom and unparalleled experience, has often emphasized that the majority of people steer their approach towards stocks down the wrong path. They are ensnared by the allure of making quick profits, often longing for overnight fortunes. They tremble in fear at the idea of market downturns, scared that their investments may plummet. Their view is short-sighted, focusing only on immediate results while overlooking the bigger picture. However, Warren's secret lies not in extraordinary luck or exceptional intelligence. It's in his approach, which is fundamentally different. He perceives stocks not merely as abstract figures fluctuating on a graph, but as fractions of solid, overwhelmingly American businesses. Each stock represents a slice of a company. A share of it's the general public. He doesn't get carried away by the daily ups and downs of the stock market. He doesn't allow the usual market fluctuations to cloud his judgment or sway his decisions. Instead, he maintains a clear, steady focus on the potential of his investments. He's not in the market chasing the ephemeral thrill of the daily roller coaster ride. Why would he when he has his sights set on a far grander vision? He's committed to the long game, thinking 10 or 20 years down the line, building a portfolio that stands the test of time and the caprices of the market. He's always looking far beyond the horizon where most people barely dare to glance. Buffett's strategy is not a secret. It's a basic principle of economics. Buy low and sell. He is ecstatic when the stock prices plummet. But what's the reason behind this counterintuitive happiness? It comes down to a simple fact. He perceives a falling market as an opportunity to purchase more shares at discounted prices. Rather than panicking over short-term losses, his focus remains unwaveringly on the bigger financial landscape. He knows that when the market eventually recovers, these investments will yield substantial profits. It's the classic Buffett buy and hold approach, which has proven successful time and time again. However, his perspective is not solely about reaping rewards or amassing wealth. The thrill of the game, the cerebral challenge of it, is what energizes Buffett, and what brings Warren the most happiness. It's not the number of homes or possessions, it's doing what he loves. He enjoys the game, and he knows he'll win over time by staying true to his principles. Buffett, with his decades of investment experience and unmatched acumen, has made a name for himself in the world of finance. His advice has always been sought after and continues to guide many in their investment journey. He firmly believes that for long-term investments, index funds like the S&P 500 are the way to go. Exploring this notion further, the S&P 500 is a market capitalization-weighted index of 500 of the largest publicly traded companies in the US. It is this vast spread of diversified companies that makes it a relatively stable investment option for those looking at the long game. This concept is the cornerstone of Buffett's advice. He argues that it's not about getting rich quick, but about playing the long game. Buffett's philosophy is firm in its belief in progress. He encourages investors to trust the steady growth of the economy even through periods of volatility.